Hello friends, welcome back to my channel Finance Unpacked with SP. In last videos, we discussed about what are the repo rate and reverse repo rate transactions and how does RBI uses it as a tool to control the money flow in the economy. But it has been observed that there has been certain lag in transferring the rate cut which the banks get from the RBI to the general public. What causes this lag? In order to answer this question, we first need to understand what are the sources of funds for the bank. Is repo rate the only source of fund for the bank so that any rate cut on repo is immediately transferred to the consumers? Well, not rightly. There are multiple sources of funds to the bank, the major being the CASA and the term deposits. The CASA stands for current account and savings account. They are the cheapest source of finance for the banks and are short-term deposits, as they are demand deposits and the consumer can demand their money at any given point of time. In contrast to that, we have term deposits also, which are FDs and RDs. They are medium-term to long-term deposits for the bank, are slightly costlier than the savings bank. However, they provide a reliable and stable source of finance to the banks as they have a fixed tenure. Apart from that, banks also borrow from RBI in form of repo transactions. They also have access to call market and money market. All these three types of borrowings by the banks are short term and are not a cheaper source of finance. But they constitute only a portion, not to give you a defined range, but generally speaking it is between 3 to 5% of the bank's total borrowings. Major sources of funds come from the CASA and term deposits. Apart from that, bank also raises the money through its equity shareholders, through bonds, through sale of its assets, through other banking and non-banking financial institutions, etc. They are a little slightly costlier than the CASA and term deposits, these type of loans, these type of sources of funds, but less costlier than the repo and call and money market transactions. But again speaking, they constitute only a small portion of the total fund requirement of the bank. So now we understood that even though the repo rate cuts happen, they form a very small source of funds for the bank. The major portion being CASA and term deposits. So we need to understand that the bank are accessing the deposits at 2 to 3%, the CASA, and term deposits in the range of 7.5%, 8%, generally speaking in the current scenarios. Now, even if there is a repo rate cut, the cost of funds that the bank has to offer to its depositors is not reduced. Why? Multiple factors. For example, there may be competition from other banks. They are offering the savings account rate of 3.5%. So even if the particular bank wants to reduce its deposits rate so that the rate at which it needs to pay to its depositors, the cost can be reduced, it cannot. Otherwise, it has the potential of losing its customers to other banks who are offering a better rate of return. So that just hinders the bank to pass on the rate cut. It may be also due to asset liability mismatch. What do you mean by asset liability mismatch? See, banks have liabilities. There may be people who have already FDs with the bank that may be maturing in 6 months or 1 year or 3 months going forward in some period. Those FDs are as per the rates which are before the rate cut. So the banks have to pay them at a higher rate of interest, 6.5%. Let's keep it in example, and the repo rate is 6%. Now, if the banks need to pass on the repo rate cut and reduce the FD rates, reduce their cost of borrowing, they can only do so for the new FDs or the new deposits. For the existing deposits, there is an agreement which is already in place and they have to provide with that particular interest rate. So that creates an asset liability mismatch. The overall cost of funds for the banks generally do not fall within 3 to 6 months period. Apart from that, there can be economic scenarios. Banks are considering that this is not the right time to cut, the risk is high in the market, so they may not pass on that rate cuts. These are the certain factors. Apart from that, we need to understand how banks are required to structure their loans. In order to structure their loans, the rate of interest on the loans, RBI from 2019 has mandated that they have to link their lending rates with some external benchmark rate. External benchmark rate means the rate at which is external to the bank. The banks internally, it is not decided. Two rates have been defined for the external benchmark rate. One is repo rate and another is Government of India's 3-month or 6 months treasury yield bonds. So as and when all your bank's loans are linked to repo rate or the government treasury yield rates, as and when the repo rate or the treasury yield rate move up and down, accordingly your loans also have to move up and down. But before 2019, the banks have to internally choose their rate, which was MCLR, which is marginal cost of lending rate, which is nothing but the cost at which the banks are getting their funds, which is the CASA, the term deposits, the repo, the operating cost, etc. And they were unique to each bank. So each bank, they have their own MCLR and they used to apply a spread or profit margin over it and pass on the rates to the consumers. But from 2019 onwards, the rates have been fixed at, not fixed but have been linked to external benchmarks. Now what happens? These external benchmark rates do not reset immediately. The time limit defined for external benchmark rate reset is, for repo rate is just 3 months, maximum 3 months, and for MCLR it is generally takes from 6 months to 1 year. Why? As we have already discussed, the FDs, the term deposits, they may be maturing in future period, 3 months, 6 months to 1 year. So that cost of funds, in order to get reduced, it takes at least 2 quarters to pass on the rate to the consumers. And that is why the banks take certain amount of time to pass on the rate cut to you, in the form of reduced rates on your loans, and simultaneously they also reduce your savings rate and FD rates. After April 9th MPC meetings, majority of the banks have reduced their lending rates as well as their deposits rate. So the reduction in the deposit rates cause easy cost of funding for the banks. Their cost of funds, their cost of getting the funds is borrowing is getting cheaper, and therefore they also can pass on the rate cut, the repo rate cut, the external benchmark, which is for the external lending of the banks, and hence the money becomes easily available to the public. I hope that answers your question about how does repo and reverse repo rate transaction affect our loans and deposits, and why there is a lag between the transfer of repo rate cuts to the general public. What else you want to understand in the in our next video? Do let us know in the comment section. Thank you.